Welcome back. Today, we are cutting straight to the core of the HCLTech Q2 fiscal year 2026 earnings call. We've got a stack of info here that seems to reveal much more than just the headline numbers.
That's right. I mean, the macro environment for Indian IT, it's still pretty complex. We're seeing some, say, tentative signs of acceleration, maybe.
Maybe, yeah.
But, there's still that persistent uncertainty, especially around U.S. demand, tariffs, all that. HCLTech came into this print with, I think, slightly muted expectations from the market.
Right. So our job today is really to look past that surface noise, identify the real operational inflection points, and figure out if they're making a genuine structural shift or just, riding a temporary wave.
Exactly. What's really changing under the hood? Okay,
let's unpack this. Headlines first. By most measures, this looks like an all-round beat operationally, wouldn't you say?
I'd agree, yeah.
Revenue came in at 31,942 crore rupees. That beat consensus, showing pretty robust growth, 4.6% year over year in constant currency. Profit was stable too. GAAP net income of 4,235 crore. Pretty much in line with what the street expected.
Yeah, the financials themselves show resilience, definitely. But I think the real story, the forward momentum, that's kind of captured entirely in their bookings figure.
Okay, let's go there, because that's where it gets interesting. Total contract value, TCV, for bookings hit a massive $2.57 billion. That's a 15.8% jump year over year.
Huge number.
It's a powerful signal, right? Suggests the pipeline is healthy. But we need to look under the hood, like you said. What's the quality of that growth?
Well, the immediate takeaway for the market was definitely surprise. I think investors were pricing in some softness, maybe weakness, but HCLTech delivered strength instead.
And the quality point.
Right, the quality. The fact that this $2.57 billion TCV was achieved without relying on any single mega deal, that speaks volumes.
Okay, so it's not just one big whale.
Exactly. It signals much broader demand across different clients and services, which is, arguably much healthier in the long run than depending on one huge contract landing.
Makes sense. And that broad-based demand, does it show up in the segment performance?
It does. Look at the services segment. It grew 5.5% year over year in constant currency. And that was driven by both their IT and business services, and also the ER&D side, engineering and R&D.
Okay. And where did they find the geographic strength? Was it just North America?
Actually, no. That's another interesting part. They found it in diversification. Europe saw solid growth, 7.6% year over year. But the rest of the world segment, that grew an impressive 17.9%.
Yeah, 17.9.
Yeah. So it means they aren't overly reliant on maybe a softening North American market for that extra bit of growth. They're finding it elsewhere too.
Okay, so the operational engine looks strong, diversified. What about the discipline? How are they managing the capital, delivering returns to investors?
Yeah, this is where their execution discipline really shines through, I think. Their free cash flow to net income conversion, over the last 12 months, it stands at 125%.
125%. That's strong conversion.
Very strong. It's a hallmark of really efficient financial management. And we also saw them maintain their dividend track record. This was the 91st consecutive quarterly payout, 12 per share.
91 quarters in a row.
91. That kind of stability, that consistency, investors definitely notice and respect that. And critically, their returns on invested capital, the LTM ROIC for services, is now 45.3%.
Okay, 45% ROIC. That sounds high. For listeners who might not track services firms super closely, what makes that number stand out?
Right. Well, in a services business like IT, that high ROIC shows really superior efficiency. Unlike, say, a manufacturing company that has to buy huge factories or machines.
Right, lots of physical assets.
Exactly. IT services firms mainly invest in people, talent, and technology platforms. So 45% return means they're generating excellent income from every single dollar they choose to allocate. It's just strong evidence of operational leverage and, frankly, smart capital deployment.
Got it. Smart use of their money. Okay, let's shift gears now to what they're positioning as a key strategic differentiator. Advanced AI. Management made a point of calling out that revenue from their advanced AI segment crossed $100 million this quarter.
Significant milestone.
It is. That's roughly 3% of total revenue now, which feels less like just an experiment, and more like it's becoming a core part of the business model.
Absolutely. I think it is. Management is clearly trying to transition the model, moving away from being purely, let's call it, people-based.
The old headcount model.
Yeah, the old linear model. Towards something they specifically call non-linearity.
Let's pause there quickly. For the audience, when a tech services firm talks about non-linearity, what do they actually mean in practical terms?
Good question. Nonlinearity basically means that the revenue growth isn't or won't be directly tied one-to-one with their headcount growth. In the old model, like you said, if you wanted 10% more revenue, you pretty much had to hire 10% more people. Simple as that.
Right. Linear scaling.
Exactly. The new model aims to use platforms, automation, AI to make revenue per employee grow faster so they can scale profits without having to scale their staff costs at the exact same rate. This $100 million advanced AI number, it's probably the clearest signal yet that they're actually executing on that strategy.
Okay. But, the term AI is everywhere these days. It's almost meaningless sometimes. What exactly are they counting in advanced AI to get to that $100 million figure? Is it just basic stuff?
No, and they were, to their credit, quite clear about this. They explicitly said this excludes classical AI, sort of traditional data analytics, and even basic Gen AI services.
Okay, so not just chatbots.
Not just chatbots. Advanced AI for them focuses on the really rapidly evolving higher value technologies. Things like agentic AI, physical AI, like robotics integration, AI engineering, and these complex AI factory implementations.
Agentic AI, can you give us a quick sense of what that means?
Sure. Agentic AI is basically the ability for software systems to kind of self-govern, to make decisions on their own and execute complex, multi-step tasks without needing constant human hand-holding. It's a huge leap in automation potential.
Okay, that sounds powerful. And presumably that kind of capability is driving client adoption. What specific traction did they mention?
Yeah, they highlighted significant traction. They mentioned their AI Force platform. I think it's version 2.0 beta now, is already deployed across 47 key client accounts.
47 already.
Yep, with a stated goal of hitting their top 100 clients soon. And beyond that, they're launching these new high-value offerings, like the AI Factory.
AI Factory.
Yeah, it's basically a packaged solution, often in partnership with folks like NVIDIA, Dell, HPE, aimed at clients who need the heavy-duty infrastructure to run advanced AI models. And this is changing the sales dynamic, too. They said most service deals now embed some advanced AI capabilities.
Interesting. So it's becoming standard.
Becoming standard. And interestingly, they said even some of their top 10 client renewals saw an increase in annual contract value. That happened despite some AI-linked productivity genes deflation, you could call it, in specific parts of the work.
How does that work? Higher ACV despite deflation.
Because HCLTech argues they're consolidating more work, specifically the more complex, higher value stuff, as AI handles the simpler tasks.
Okay, that makes sense. Consolidating up the value chain. All right, before we get too carried away with the AI growth story, let's look at the guidance and the elephant in the room, margins.
Right. Always the key question for IT services. So the full year FY26 guidance, it remains conservative, but it's stable, unchanged. They're guiding for revenue growth of 3% to 5% year over year in constant currency, services specifically 4% to 5%. And the EBIT margin range is held at 17% to 18%.
Okay, 17 to 18%. But the actual Q2 EBIT margin came in at 17.5%. And crucially, they noted it included a, 55 basis point drag from restructuring expenses.
That's right, about 55 basis points. Which means, yeah, the underlying margin was actually stronger, closer to 18% if you back that out. But investors are rightly looking ahead because there are some clear headwinds coming.
What are those specifically?
Well, we have a very explicit margin schedule coming up, salary hikes. They're rolling out post Q2, so starting now, basically. Management expects this to hit the Q3 margin by about 70 to 80 basis points.
Ouch. Significant hit.
Significant. And then there's an incremental 40 to 50 basis points impact expected in Q4 from the full rollout. So yeah, it's a noticeable step down in costs hitting the P&L in the second half of the fiscal year.
Okay, so management says they can absorb those salary hikes plus the leftover restructuring drag and still stay within that 17% to 18% margin band for the full year. But how confident should we be in that claim? I mean, you mentioned earlier that AI productivity deflation could be huge, right? Like 40, 50% in BPO, maybe 25, 30% in software development. Isn't that productivity gain a massive threat to their existing core business revenue, regardless of new AI deals?
That is the absolute core debate right now. And management knows it. They acknowledge the deflation risk from AI productivity. They're not hiding from it. But their argument is that the consolidation of those complex, non-standard, higher value programs is the offset.
The offset mechanism.
Exactly. They cited examples like big legacy system modernization projects, very complex, or large post-merger integration and carve-out work. They specifically mentioned recent big deals with Volvo Cars and Equinor as examples of this type of work.
So the thinking is, AI automates the routine, freeing up humans for the really tough stuff.
Precisely. AI takes over the more transactional, repeatable work, which frees up their human talent and the client's budget to tackle the complex digital transformation programs that clients simply can't automate easily yet. So the critical catalysts for margin recapture as we look towards FY27 are, one, those restructuring costs finally fading out completely, and two, the successful and importantly high margin conversion of that record $2.57 billion TCV pipeline they just booked.
Fascinating. Really lays out the push and pull on those margins. Okay, great insight into the margin stack there. Now, as we usually do, let's transition to our segment where we throw out a bit of a thought experiment based on all this data. And the vital reminder, as always, this is absolutely not financial advice, just a conceptual analysis, a way to think about the dynamics.
My pleasure. Okay, so the core thesis here, the way I'm thinking about it, is that HCLTech is kind of setting up as a classic delayed margin recapture play.
Delayed margin recapture, okay.
Yeah. The idea is that the current share price might be getting held back or anchored by the near-term noise around margins. You know, that visibility gap caused by the timing of those internal restructuring charges hitting the books now, plus the salary hikes landing squarely in Q3 and Q4.
So the market is maybe overly focused on the drag happening right now and perhaps ignoring the underlying structural pivot and those really strong bookings we talked about.
Exactly my thinking. Management has been pretty firm, given strong assurance that they are not structurally lowering their long-term margin band. They see 17-18% as sustainable. So, my outrageous but plausible pitch is to think about initiating a long position, maybe timed specifically to capture the expected margin expansion in Q1 of fiscal year 27.
Okay, so looking further out.
Looking just past this noisy period. Assuming those one-off restructuring costs completely fade out by then, as they should, and assuming that strong TCV backlog starts converting into actual revenue at decent margins, then HCLTech seems poised for potentially a significant margin print beat in Q1 FY27, maybe even pushing clearly above that 18% level.
And the impact of that.
Well, a positive surprise like that, especially on margins, could drive rapid multiple expansion for the stock. It would really solidify the narrative that maybe HCLTech offers the most compelling growth and profitability story among the top-tier Indian IT players right now. So the play essentially exploits the temporary visibility gap, the noise caused by these necessary but temporary internal restructuring charges and wage hikes.
That's a very sharp focus. Exploiting temporary accounting noise for a potential structural re-rating.
Interesting. Okay, so to summarize this entire deep dive then, HCLTech looks like it's genuinely successfully transitioning towards more of an IP and platform-led growth model. And the evidence seems to be there in those record bookings achieved without mega deals, remember, and that explicit $100 million advanced AI revenue milestone.
Right. I think that sums it up well. And maybe here's a final provocative thought for you, for our listeners to consider. Given management's intense focus on nonlinearity, revenue per employee is already growing at nearly 2% year over year for them.
Which is the goal of nonlinearity.
Exactly. And given the stated potential for 25% to even 50% productivity gains from AI in their core services delivery, how much longer can the IT services industry's overall headcount realistically continue to expand significantly? Even if industry revenue growth kind of holds steady in that, say, 4 to 5% range, the historical structural relationship between labor input and revenue output, it might be fundamentally breaking down right now. Something to think about.